RSI fails most traders because they treat it like a signal machine instead of a context tool. That is the core mistake behind why RSI fails most traders and what actually works. RSI, or Relative Strength Index, is just a momentum gauge. It tells you whether price has moved fast in one direction recently. It does not tell you whether the move is about to reverse, and that difference matters more than most beginners realize. I'll show you the part traders miss, because that is where the real answer lives. Here is the simple version. RSI compares recent gains to recent losses and compresses that into a number from 0 to 100. High RSI means price has been strong lately. Low RSI means price has been weak lately. Traders then see 70 or 30 and assume overbought or oversold means immediate reversal. That is where the trouble starts. In a strong trend, RSI can stay high or low for a long time while price keeps moving. The indicator is not broken. Most traders fail with RSI because they use it in the wrong market condition. In a trending market, buying just because RSI is low can mean catching a falling knife. Selling just because RSI is high can mean shorting a train that is still moving. RSI works better when price is already stretched and losing momentum, not when it is simply strong or weak. That is a big distinction. A strong trend can keep RSI pinned. A tired trend starts to show divergence, failed pushes, or loss of follow-through. Those are different setups. So what actually works? I use RSI as a filter, not a trigger. First I ask, is the market trending or ranging? In a range, RSI can help identify exhaustion near the edges. In a trend, I want RSI to confirm momentum, not fight it. For example, in an uptrend, a pullback that resets RSI without breaking structure can be useful. In a range, an RSI move back from an extreme can support a mean reversion trade. The indicator is most useful when it is paired with price structure, not used alone. The next problem is that traders obsess over the exact number. 70 and 30 are not magic lines. They are rough reference points. On some assets, 80 and 20 make more sense. On others, 60 and 40 matter more because the market trends harder. That is why a fixed rule often disappoints. The number only has meaning relative to the market you are trading. If you ignore that, you end up forcing one indicator to do the job of a full trading plan. What usually works better is a simple sequence. Identify trend, mark support and resistance, then use RSI to judge whether momentum is helping or fading. That keeps the indicator in its proper role. It becomes a timing aid, not a prediction engine. And that is the honest answer to why RSI fails most traders and what actually works. RSI fails when it is asked to predict reversals by itself. It works when it helps you read momentum inside a market structure you already understand. So my judgment is straightforward. If you want RSI to save bad entries, it will disappoint you. If you use it to confirm context, spot exhaustion, and avoid chasing late moves, it becomes much more useful. That is not a guarantee of profit. It is just a better way to use a simple tool. And in trading, simple tools usually fail when people demand certainty from them.